All right, to the second headline now. India's largest mortgage lender, HDFC, fell by under 1% despite beating estimates in the second quarter. Asset quality has hit its highest level in nearly 3 years. Retail assets under management is at a near 5-year high. Abhishek Kothari joins in with the details on that one. Abhishek, what do you make of the numbers?
Well, operationally, it's a strong quarter for HDFC Limited. Let's take a look at the asset quality, which is perhaps one of the best in last 11 quarters. So the overall gross NPA ratio is at 1.59%. This compares to about 1.78% in the previous quarter. Even the non-individual gross NPA ratio has now come down to below 4% level at about 3.99% when compared to 4.44% in the previous quarter. In the overall AUM growth, retail AUM growth actually stands out given the fact that individual AUM has grown by 19.1% on a YY basis, which is perhaps the best that you are seeing in last 19 quarters. So cost to income ratio has dipped down to 8-quarter low of 9.1% when compared to 10.34% in the previous quarter. So this has driven a strong operating profit growth up about close to 48-49% on a YY basis and about 15-16% on a sequential basis. Loan growth has not meant that the net interest margin has improved. It's largely remained flat at about 3.4%. However, the spreads have improved by 3 basis points sequentially, coming in at 2.28% when compared to 2.25% in the previous quarter. So PNL, both the NI and PAT is a beat on our poll. Back to you.
All right, Abhishek, thanks a lot for that. Let's move on to M&M Financial. That soared over 13% in trade today after posting their earnings, and the business update for October as well. The second quarter disbursals are at a 16-quarter high, which also has translated into good assets under management growth. We spoke with the company's VC and MD Ramesh Iyer earlier today, and this is what they had to say about their business going forward. Remember, the street really liked those numbers. The stock ended at the high point of trade.
Clearly, maintaining a 10,000 plus crore disbursement should not be a challenge. The second half for rural is the best half. And fortunate, the monsoons have been good. Support prices seems to be good. Infra is opening up. So we are very, very positive in terms of the trends that we see in the rural market, both from demand as well as from the collection front. AUM, we are already clocking 15-16% growth, and the disbursements are more aggressive as we see from the numbers. So therefore, maintaining this kind of a double-digit growth on the AUM should not be a challenge again.
All right, moving on to more banking news, sticking around with the financials actually. Bank of India also reported their decent set of numbers. The asset quality was again the best in the last 7 years. The net interest income also saw a 25% jump. We spoke with A.K. Das, the Bank of India head, and this is what they had to say about the business going forward.
NIM has been the cynosure this time. Our global NIM is 3.04 and domestic is 3.49. And I must tell you, domestic has 86% of my loan book. So that's a substantially improved number. In the domestic arena, 12% growth. Corporate credit has grown only by 6%, whereas RAM has grown by 15.75%. Driven primarily by retail 23%, agri 19%. And MSME at a somewhat moderate 9%. Slippage numbers has been very good indeed. In fact, that has been one of the major factors for our P&L. Total slippage was only about 1,200 crore in the entire quarter. I'm talking about net slippages because recovery action also is going on.
And with that, we move on to the third headline for the day. Some primary market action. India's third largest ethnic snacks maker, Bikaji's 880 crore rupee IPO opened for subscription. 880 crore rupees worth offer for sale, which means that this will be the money that will go to the promoters and the investors as against the company. It's an entire offer for sale. The company is looking at a post issue market cap of around 7,500 odd crores. Importantly, it is India's third largest ethnic snacks maker, which is the largest bhujia maker in India as well. And if you just take a look at the revenue mix, 35% of it comes in from bhujia. We have around 39% coming in from namkeen, 7-8% coming in from sweets as well as western snacks, the works. So in case you're hungry, let me tell you a little more about the strengths of the business. They have a strong brand. The capacity utilization that they're at right now is around 30 to 50%. So that leaves them with a lot more headroom for growth as well. And 75% of their revenues are concentrated between Rajasthan, Assam as well as well as Bihar. So them moving out into other places will be extremely important to watch out for going forward. But if you just take a look at their numbers in FY22, they did about revenues of 1600 crores with 7% margins and profits of around 75 crores. Competition would be the key risk going forward for them, and any sort of improvement in margins is something that we'll be monitoring as the company looks at other geographies for growth. For all of this, what do you have to pay? Well, the first quarter of this year, they did about 15 crores of revenue. So if you assume that they go ahead and grow faster to even about 25 to 30 crores of net profit in the next 4 quarters, then the company is being offered at a price to equity ratio of price to earnings ratio of close to around 58 to 60 times, which is elevated even by other FMCG standards. So it'll be interesting to see what kind of demand that we see for this IPO, and importantly how the stock performs once it lists. We also caught up with the MD of Bikaji Foods, Deepak Agarwal, earlier today, spoke about the plans for the company going forward.
In the last 18 months, we came with plant across all parts of India. So like Rajasthan, Assam and Bihar, these three are our core market where we are having leadership market position. Like in Rajasthan, we are having market share of 45%. In ethnic snacks market. In Assam, we have market share of 58%. In Bihar, we have market share of 29%. So we have a very strong market leadership position across all 3 markets. And we have started focusing on 4 states in North India, like UP, Delhi, Haryana, Punjab, and 2 states in South, like Karnataka and Telangana.
That's not all. The IPO of Global Health, which operates the Medanta chain of hotels, is also opened for subscription today. Ekta Batra is here with all the details.
Well, yes, Medanta, the IPO has opened today up till the 7th of November. The price band is 319 to 336. They're looking to raise up to around 2,200 odd crores. Implied market cap is anywhere between 8,580 crores to a little over 9,000 odd crores. It is a combination of fresh issue as well as OFS. Fresh issue is to the tune of 500 crores. OFS is up to around 1,700 odd crores. With Carlyle exiting entirely, they did enter the company in 2013, had around 25.6% stake or thereabout, and now they have already struck a pre-IPO deal to the tune of around 6% of equity, and with the OFS they are expected to make a complete exit from Medanta. Now in terms of fund utilization, 375 crores of the fresh issue will be invested back into 2 subsidiaries of Medanta. Now about the company, remember that it is Dr. Trihan, who is a renowned cardiac surgeon. It is a company promoted by him, and it operates a network of around 5 hospitals. All of them are focused in the north as well as the eastern markets of India. They have 6 multi-speciality clinics, so a total of around 2,467 beds, and 1 hospital coming up in Noida as well. Now, a couple of key points to remember. The advantage is that it is a strong doctor promoter name, which is attached to this particular brand. Separately, the occupancy rates have been 59 to 60%, so it has the scope to improve. Average revenue per occupied bed for the company has improved to around 60,000 rupees. International revenue is picking up. So for example, it had fallen to around 4% from 10 to 11 odd percent, and now has risen to around 6%. New verticals, they are investing in the likes of pharmacy as well as home care, and they do have other verticals such as diagnostics and digital, which they are exploring. They are looking to expand their bed capacity as well. And as of now, in terms of numbers, Q1 FY23, they did report margins of around 20 to 21 odd percent with a revenue growth of around 27%. Valuation wise, it's at around 18 times EV to EBITDA on an FY22 trailing basis, so it's less expensive than the likes of Apollo as well as Max, but it stacks up to be more expensive than a couple of the smaller hospitals available.
All right, thanks a lot for that, Ekta. With that, we'll slip into a short break. On the other side, we'll get you more headlines. Welcome back. You're still with us here on Markets Today. Let's go to the rest of the headlines that we're tracking for you today, to the market, the financials, as well as the IPOs. Let's talk about macros. Former RBI Governor Raghuram Rajan has termed the Fed's policy hawkish and said that rates will continue to rise in the short term. Several investors have accused the Fed of sending mixed signals. Abhishek Datta Roy and Ritu Singh report on the varied reactions to the US Federal Reserve's latest monetary policy.
The Jerome Powell-led Federal Reserve pretty much stuck to the script, approving a 4th consecutive 75 basis point hike in benchmark interest rates. Their intent reasonable: US is currently grappling with a 40-year high inflation rate. However, the markets were expecting Powell to adopt a more dovish tone and hint at rate hikes of a lesser magnitude going forward, and that initial statement seemed to hint at that. It said, and I quote, "The committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments," end of quote. Wall Street started to rally, but it was short-lived when Powell took to the stage and said,
"We still have some ways to go, and incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected."
"We still have a ways to go." The message from Powell was clear. Rate hikes are likely to continue.
Fed raised interest rates as expected, but Chairman Powell also came in with slight mollifiers for the market. Yes, over the next meeting or two, we will start slowing the pace of rate increases, but we're going to go higher than you expected. Because, he did say that we haven't seen much of an effect on inflation yet, and the labor market is red hot, so we need to do more. I think the one additional piece of dovishness was we don't need to see inflation come down significantly before we slow the pace of rate hikes. So that, for a while, the market took some comfort from that. But in general, it was relatively hawkish.
Stock markets went into a tizzy, and many investors accused the Fed of sending confusing signals.
Sometimes referred to the FOMC as the Federal Open Mouth Committee. There aren't too many of them that are just too anxious to speak. Chairman Powell really just came out with the most hawkish position. I would call it Volcker 2.0, basically saying, we're just going to raise interest rates until we find the level that starts to convincingly bring inflation down.
Yardeni was referring to the late Paul Walker, who served as the Fed chair from 1979 to 1987 and is widely credited to have tamed the high inflation that plagued US during that period. In fact, Jerome Powell, while speaking at a conference in 2019, referred to Walker's memoir, Keeping at It, The Quest for Sound Money and Good Government. He said, and I quote, "I actually thought I should buy 500 copies of his book and just hand them out at the Fed," end of quote. Powell also defended the actions of the Fed so far.
I don't have any sense that we've over-tightened or moved too fast. I think it's been good and a successful program that we've gotten this far this fast.
The key policy rate in the US stands at 3.75 to 4%. Citi has raised its expectation to 5.25 to 5.5%, hinting that there is room for rates to go up by another 150 basis points. If this turns out to be true, Standard Chartered expects the rupee to depreciate beyond 84 levels against the dollar.
Let's move on away from macros, once back again to micros. Dalmia Bharat rallied close to around 4% today after the company delivered a steady performance in the second quarter. In fact, a bright outlook from the management also aided the stock. Nigel D'Souza joins in with the details. Nigel.
Well, Dalmia's numbers were in line, which isn't too bad, given the fact that some of its competitors, well, they missed estimates by a big margin. So top line bang in line, EBITDA as well as margins in line. The PAT looked better, but that was because of some tax credit that they saw in the past quarter. What works for Dalmia Bharat really is that they are around a 35 million ton capacity as of last year. Now that's going to increase to around 49 million tons odd. And some part of the street believes that they deserve a better multiple from here on. As of now, they trade at around 9 times EV upon EBITDA. So for a large size company to trade at single digits, well, some part of the street believes that maybe double digits would be more appropriate. Now, the management on the con call as well sounded fairly confident. They said that they're expecting big margin recovery from here on, as the worst is behind for them. Volumes will improve, pricing will improve, and input costs will cool off. Besides that, they said that they're likely to grow at 1.5 times what the market grows. And finally, they also said that they could possibly on the prowl for inorganic as well as organic expansion. So they're looking to expand as well. So Street read all of this positively and explains why the stock did well.
All right, Nigel, thanks a lot for that. That's not all. Alembic Pharma also rallied over 7% after the company received a green signal from the US drug regulator for one of its injectables. What does this mean for the company and the opportunity? Ekta joins in with more details. Ekta.
Well, yes, Alembic was in focus on account of a drug approval for an injectable that they received from the US FDA. This particular drug is used to treat pain. The market size is not that big in terms of size. It's around $59 to $60 million. But it was important because it is the second injectable that they've received approval for just in the past couple of days, and from one particular facility, which is the F3 facility, a sterile injectable facility. Now, this particular plant is important because in November of 2021, it had received 10 observations. So the street was skeptical on whether or not this particular plant would see the light of day when it comes to the US drug regulator. It was re-inspected in August of 2022 when they received around 2 observations, and after that they have received 2 injectable approvals from this plant, indicating that it is a go-ahead for this particular facility. The company also received an approval for a colon drug which is called Pentasa generic, the generic version of Pentasa, and that too would be important. So it looks as though the approvals are lining up as positive for the US business of Alembic, which in fact has been a bit sluggish. To put it into perspective, in Q1 of FY23, the US business sales were around $48 million. The street was anticipating around $50 to $55 million. So going forward, the hope is that with approvals stacking up, especially for injectables, there could be a renewed amount of gains that we could see for the US business for Alembic.
All right, Ekta, thanks a lot for that. With that, we're out of time on this edition of Markets Today. Thank you for watching.